let's start with the president this morning tweeting that it's a big mistake, as he put it. It's a big mistake to sell stock right now because the fundamental economic news is all good. Who's right, the president or the market?
Look, the president's been right about the market since he was elected. You might recall that Paul Krugman said the market would never recover, and I think that smoothing through the ups and downs, we're probably up about 35% right now since he was elected. And it's not just mumbo jumbo, it's not a mystery. The reason why the market is up is that the president has pushed policies that are good for workers, good for the economy, good for business, and there's been this medium-term upward trend that's very significant. I think that, day-to-day fluctuation is something that we're always going to see, and the president understands that, but what he's pointing to is strong long-run economic fundamentals, which in the long run are going to be really good for equity markets as well.
Kevin, as you say, good for workers, and in part good for workers in wages, because one of the things we saw on Friday were those wage numbers come out with 2.9% increase in wages, and many observers think that that really was the first trigger for the market sell-off because people were worried about inflation. Why were people wrong, given those numbers, to be concerned about inflation?
Well, I'm kind of a Chicago-style guy, so I don't want to ever say the market is wrong or right. But, on the show, we've been talking, going all the way back to the fall, about the fact that wages are going to go up because we're cutting corporate taxes, and that's going to increase the marginal productivity of workers and drive up their wages. And we're starting to see that in the data. As you know, hundreds of companies have offered raises or bonuses because of this. And the data that came out on Friday showed that we had the biggest increase in wages in about 10 years. And so the market's worried that that's an inflationary sign. But as an economist, I think that I don't see it as an inflationary sign, because if wages are going up with productivity, then it makes complete sense. It's different from a sort of normal Phillips curve event. And so think about it this way. If you go back to your supply and demand curve from your Econ 101 class, if you shift the supply curve out, then quantity goes up, but the price goes down. And so a big supply side tax cut right now should actually put downward pressure on inflation, and it should be good news for those who want to see a sustained recovery.
Yeah, you're asking me to reach back a long way to my Econ 101, but I do remember something about that. But explain to me that productivity growth, because if you have more dollars chasing the same goods, then obviously that drives up price, you get inflation. So you have to be able to produce a lot more goods, but actually productivity has not been increasing at that fast a pace. I mean, the Bloomberg has something like 1.2% or something like that.
Oh, right. Well, don't forget that the capital spending contribution to productivity growth in the second half of the Obama administration went negative for the first time in U.S. history. So wages were declining because they had chased businesses offshore and all the capital formation was overseas. President Trump has brought that stuff home, and that's going to lift productivity. Now, the wage increases are coming faster than even we expected, but I think there's a strong explanation for it, which is that firms are optimistic about what this tax cut and the deregulation are going to do for this year, and are worried about retaining their workers once all these new factories start locating in the U.S. And so they're preemptively increasing wages because they see the higher productivity coming right around the corner.
What are your models showing you about the rate of productivity increase that you can expect? Because as a practical matter, as you know so well, you basically get growth from productivity and increased number of workers. We've had like, what, 0.5% more or less growth in the size of the worker force. So what kind of productivity are you really looking at?
Well, I think that we're going to, sit back this year and watch what happens to productivity growth and capital formation. But all the signs are that it's lifting off in a way that we haven't seen since before the Great Recession. One of the things I most like to look at, and I know you folks cover once a month when it comes out, is in the advanced durables data, they have spending and orders and shipments of non-defense capital goods, excluding aircraft. And when you see the orders being ahead of the shipments, then what that means is that future shipments are going to be a lot higher. And so right now we're looking at a double-digit growth capital formation year, and with that, then you can expect significant productivity gains and significant wage gains that won't be inflationary.
But if you're looking at 2.5% growth, or I believe you're looking at closer to 3% growth, and you have right now the Fed saying that basically the capacity is around 1.8, what sort of numbers, where do you have to get productivity up to? Are you looking at 1.5, at 1.8, at 2% productivity increases?
Right. Well, I think that what's going to happen is we're going to see the capital formation, but to get sustained 3% growth, in the end, that potential GDP calculation, like the one you alluded to, is something that matters a lot. But up front, the capital spending itself can get you to 3% growth before it feeds right through into productivity. So what I think that we expect is that the capital spending boom is going to drive growth up this year, and then the output from all that capital is going to drive up wages and productivities as we go forward.
And then, Kevin, finally, I'm curious curious how the machinations in the markets up here in New York are looking from the White House, where you are right now. I understand that you've been in constant communication with various regulators to figure out how the markets are responding, how regulations are working. Who are you talking with? And when you call up people, who do you call and what do you hear?
Right. Well, Secretary Mnuchin, Gary Cohn, and I remain in contact with financial regulators. Of course, we have to keep those conversations to ourselves. But the thing that we're looking for is to make sure that markets are functioning smoothly, and that if there's a circuit breaker, the circuit breaker's working, and so on. And the fact is that markets have functioned smoothly through all this volatility, and the fundamentals of the economy remain strong. And so the point is that you have to, of course, if you're in a situation like this and in a position like mine, monitor the situation closely. But that's the normal course of business. If you want to ask, what the conversations look like, then maybe what you should do is get one of my friends like Austin Goolsbee on the show and say, when there were, volatile days, who did you talk to and what did they say? I think now he could look back, and it's, enough time has passed where he could speak frankly about those conversations. Good